Good afternoon, welcome to Lbma webinars. Today we are talking inflation, tapering and the macroeconomic outlook. To join us today we have James Steele, he works for HSBC. We have Rhona O'Connell from Stone X Financial, and we have Suki Cooper from Standard Chartered. These three are members of our Public Affairs Committee. We have recently nominated Chair Suki and Vice Chair Rhona. So they're here to deliver you an exceptional webinar. We'll be putting them to the test. Before I hand over to them, however, I'm just going to take you through a housekeeping slide. If you have any questions about the webinar, please put them in the Q&A panel at the bottom of your screen. If you've got the new version of Zoom, could be at the top screen if you have the old version of Zoom. If you're having trouble finding either of these, please email ask@lbma.org.uk and someone will either forward your email across during the live webinar or get back to you after the webinar. This applies if you are watching a recorded version. I will make sure to get you an answer. So without further ado, Rhona, would you like to take the floor?
Thank you, Taylor. Yes, indeed. Good morning, good afternoon, everybody, or good evening. Thank you very much for joining us. I hope we do you justice. Now, today, of course, is the day after the first 2022 meeting of the Federal Open Market Committee, which I suspect has something to do with Taylor's wonderful administrative foresight. She's put us in here so that we can respond to the most recent developments from the FOMC, for which, thank you, makes my job at least a tremendous amount easier than it might otherwise have been. So I'm going to focus predominantly on what came out of the Fed last night and the implications for the markets and how the markets have reacted, or perhaps I should say overreacted. I'll be interested to see how Jim and Suki think about this. But last year, practically every FOMC meeting that we had, and for several years before that, to be fair, almost invariably produced a knee-jerk reaction once we got the statement and then a little bit further into Jay Powell's press conferences. And usually, as far as gold was concerned, it was a knee-jerk downward reaction because everybody was concentrating on tapering, whether, when, to what extent, and obviously rate hikes were already baked into the psyche to a certain extent, but the last 6 months or so it was tapering. And now, of course, we've got balance sheet runoff. So the essence of what happened yesterday evening, in my view at any rate, was that the markets overreacted. It's, as I said, they almost invariably do. The two-year yield shot up. Gold was actually already falling in anticipation of the statement, and then it fell again, and then dribbled sort of gradually lower over the course of the Asian and certainly the London morning trading hours. Now, why? What's different? And to some extent, if you just read the statement in its bald nature, there's not a lot that's different from December, for that matter. But even so, the markets went into a tailspin, and there was some talk that they might even be discounting 5 rate hikes this year. Now, I'd make 2 points about that. Firstly, I am quite strongly of the view that apart from the fact that the incidence of a rate hike is always going to generate a market reaction in the short term, what is much more important in terms of the longer term impact on economic activity, it's not the number of times the rates are hiked, it's the cumulative level by which they are hiked. I think that's really important. It doesn't seem to command that much attention. At the moment, if you look at the December dot plot, then the forecasts from the market committee members was for anything from a 75 to 100 basis point rise over the course of this year. The implications or the inferences to be drawn from the market's reaction overnight is that we might even be looking at more than that. Jay Powell, Fed chair, was asked in the Q&A session whether there would be rate hikes in consecutive meetings, and for that matter, whether the Fed felt that they were in a position to front load. The implication here is 50 basis points in March. And Jay Powell, quite rightly, to some extent skirted the issue because he does put a tremendous emphasis on being led, and he actually said led, not influenced this time, being led by economic data and the evolution of economic and financial patterns. So to that extent, the market could be seen to have overreacted, but there were a few things which were nestling in the press conference that I think probably are significant. One was Jerome Powell's repeated use of the word strong, particularly with respect to economic activity and labour, and his first reference also to persistent real wage growth and how that could potentially pressure inflation, especially if it was growing faster than productivity. So he has taken a more hawkish view. Now, we all know that he became more hawkish than he had appeared, once he had had the renomination. But this is more hawkish yet. So that does fuel the fire of the market's reaction to some extent. And the other thing on top of that is the assertion that labour conditions are currently consistent with maximum employment, which of course is part of the Fed's dual mandate. Although again, he did say in the Q&A session that over time this could evolve, particularly as we have a low participation rate. This brings us all the way back to the virus, which of course is lurking in the background and colouring views on just about everything. It is a known unknown, if you like. And one of the points that he was making was that the participation rate, which is the percentage of the potentially available workforce that's actually looking for jobs, it was stubbornly low, around 61.6, maybe 61.7% towards the back end of last year. It's now up to 61.9, which ties in with maximum employment at the moment as the Fed sees it. And it has a whole panoply of different parameters that it uses. It's not, as Jay Powell put it last December, it's not just a headline number, it's a judgment call. But the other point that he was making that's relevant to this was that the comparatively low level of the participation rate is still to some extent a function of the fact that there are people who would ideally be looking for work, but they're still in a carer role because of people who are ill in their families. So we had this whole jumble of different factors, all of which are leading Powell to talk about the Fed being, as I say, led by data, being nimble, being humble, and doing what they see fit in order to keep inflation under control without hurting employment. He said that because there are many, and I quote, many millions more job openings available than there are people looking for work, he thinks that they can raise rates consistently, and he didn't say with what periodicity over the course of the year without having too much of an impact on employment. And the other point that he was making was that, and this is enshrined in the principles defining how the balance sheet will be shrunk, which is a new publication that published in line with the statement yesterday. And the point in the first of those principles is that the rate hikes will be the key tool. So I tend to think of this as the iron hand inside the velvet glove. The rate hikes, which are tangible, they'll capture headlines. People on the street will know what kind of impact it's going to have on their income. Well, not their income so much, but the way that they balance their balance of living, obviously borrowing and so on and so forth. While in the velvet glove, you've got the shrinkage of the balance sheet going on in the background. Now, there are two ways to look at this. One, you'll have the rate hikes and the balance sheet shrinkage working together, which between them, if it becomes, as a result, becomes quite aggressive, that's a headwind for gold. If, on the other hand, the shrinkage of the balance sheet, which just trundles along quietly in the background and is equivalent to, let's say, 1.5%, 2% on or Fed funds rate equivalent, then that could give the Fed a degree of flexibility for a more benign approach with respect to the Fed funds target rates, which would be a tailwind for gold. So having thrown out those two options and possibly plenty more that's muddied the waters, I'm going to hand over to Jim to try and make some sense of it all.
Thank you very much, Rhona. That is very interesting, and indeed. Now, we are looking at my remit for today is a bit more guarded on inflation, but just to say what our views are post the FOMC. We're looking for 3 rate hikes still, despite what came out, but we've moved forward our views on beginning of quantitative tightening to quarter 3. With respect of some of the things that you had said, Rhona, I do think that the market has already well digested what the Fed was going to do, and in that case, we do tend something of an overreaction. And it also strikes me that it's easy to forget that monetary policy is so extraordinarily accommodative up to this point that even several Fed rate hikes are still going to leave us in a historically easy position. And we don't know yet what impact this is really going to have further down the curve. Say for and what gold has shown itself to be sensitive to is the real yield on the 10-year. And that, from all my calculations and from what HSBC fixed income is looking at, is still going to be negative, very likely. I mean, I think we're up at 182 today, but given inflation levels, that keeps us in profoundly negative real rate territory. So I think that's something to be noted. The other thing too is that when you talked about tailwinds and whether Fed policy would be a push or not for gold, we still have to see how the equity markets are going to react. Now, if you like, the tone of Chairman Powell's comments yesterday seemed to move against a so-called Fed put. When he was asked about the volatility of the financial markets, he didn't appear to be overly concerned. And this is something I think that was picked up when we did a piece on a multi-asset piece. That so if we get more profound declines in the equity markets, and I'm not saying we will, I want to make that quite clear, then we could see gold being utilized more as on the safe haven front. Suki, do you have any comments on Rhona's stellar presentation?
I think Rhona and Jim, you've set the scene great and summed up very nicely what was said by Fed Chair Powell yesterday. But I think there's gold's reaction. Perhaps it was extreme, but I think it perhaps was needed as well. If we look at where real yields were trading at the moment in comparison to where gold prices were trading, gold was a little bit frothy. Last time we saw real yields drop by this sort of magnitude, gold prices technically should have been maybe trading around 1760 instead. So we could say that gold had priced in a number of those headwinds. We could also argue that there was perhaps some safe haven interest playing into gold as well as some robust physical demand that was helping to keep gold prices well above 1800. So on the one hand, positioning was actually quite light ahead of this meeting. But if we compare gold positioning ahead of the first rate hike in previous cycles, whether we're looking at December 2015 or going all the way back to 1994, gold net fund length at the moment is actually quite elevated. When we were at this point ahead of the first rate hike back in December 2015, we were in net short territory. And at the moment, gold positioning is almost 40% below where we were at this point last year, but it's still very much in positive territory. And if we look at gold prices and gold positioning leading up to that first hike, we tend to see that most of the net fund length is flushed out ahead of the first hike. And thereafter, we tend to see prices starting to stabilize and starting to gain upward momentum. Gold is very quick to price in some of those headwinds and some of that negative news. But I think the other comment that was discussed around quantitative tapering was very, very interesting as well. The last time we had quantitative tapering was back in between October 2017 and July 2019. And over this period, if we'll recall, through 2018 was when we had 4 Fed rate hikes at the same time. So we had, at that point, gold prices did come under pressure and we were testing the levels that we saw back in December 2015, which were the lows of the hiking cycle. But I think the main takeaway here is that gold prices are likely to come under pressure, but the fact that the focus more now so is on rate hikes rather than quantitative tapering means that that's where the market focus will be. And gold has very much been tracking real yields very closely rather than the dollar, and that correlation remains strong. But I think gold prices may have got ahead of themselves at the start of this year. So I'll pause there, Jim, and I'll pass back to you.
Okay, well, thank you. And my remit for today's discussion is to discuss the impact of inflation a little more. But just before I move into that, I should point out that we are looking for reasonably strong growth this year on a global level at around 1%, moderating to 3.2 for next year. And on inflation, we're looking for global inflation to be about 4.6%, moderating to 3.3% next year, with the US at similar levels. That's from Janet Henry, our chief global economist. But there's been so much talk about inflation that I just want to point a couple of things out. First of all, we're looking, Ryan Wang, our US economist, is looking for US inflation to peak around Q2 and then moderate after that. Supply issues we're looking for to moderate a little bit. The Fed tightening will start to kick in and keep going forward. But a couple of things to point out about inflation and gold. We've seen, and this really shows the division between Wall Street and Main Street, I think. What we've seen is the retail audience react to, and we all know inflation has gone up, and that's undeniable, and it's prompted the Fed to do what it's doing, what it was going to do. But we haven't seen the institutional market react to it very much. The institutional market is continuing to take the sort of academic view, which is that inflation is going to moderate, and also the general central bank view globally, which is that inflation, the Fed has removed transitory, but still going to moderate later in the year. Whereas those of us that go to the grocery store and the petrol pump, they are buying coins and small bars. The retail market is very active and very strong, whereas we don't see inflation-led institutional buying. So I think that's a big division between the markets right now. Gold is also not a good inflation hedge. I would mention that. I mean, I think that a lot of people think because this is an Lbma webinar that we're always going to be pro-gold or pro-metals in all aspects. But our job is to point out the facts. And if you look at gold historically, and there's a number of academic studies, that have shown that it depends on where in the inflation cycle you decide to buy gold. What gold is an excellent portfolio diversifier and a very good safe haven. But that's not to be confused, I think, with its role as an inflation hedge. In fact, there's been a recent academic paper put out, The Best Strategies in Inflationary Times, which points out that gold might not be good, by Campbell Harvey, which points out that gold might not be a good hedge because of the volatility. And I think that's just something to be borne in mind. And what we do see is a division in gold demand across the globe because of this. Inflation seems to motivate retail buyers in Asia more than it does in Western markets. And I just want to point that out because it shows that gold's multivariable, multifaceted applications. But I would just finish by saying that we are entering an era of monetary and stimulus reduction from profound levels, and the gold market, I think, will still have to keep accommodating that. And Suki, I'll hand out to you.
Thank you. I think when we're looking at core PCE tends to be the inflation measure that we tend to focus on, and the market started this year with a huge focus on inflation. I think that's one of the reasons why gold prices caught an early bid, was because of the concerns around inflation risk. But we do expect inflation to start to moderate this year. We're expecting core PCE to average 4% in Q2, but by the time we get to Q4, we're expecting to average 2.7%. So we do see inflation starting to trend lower. And the main reason behind that is that we think that some of the supply chain bottlenecks should start to ease. But if we think about the main drivers behind inflation, we can perhaps group them into four categories. We can obviously the reopening, or just a simple reopening of economies after COVID led to an increase in demand. And we think that going into this year, that's not going to be as big a driver, it's not going to have as large an impact. So it will be much more a softer impact in terms of demand driving up inflation. But we've also had huge support, as you mentioned, Jim, around monetary policy as well as fiscal stimulus. And then the supply chain bottlenecks on top of that have caused inflation to spike in the US to multi-decade levels. But we think that this year, a number of those factors should start to ease. And H2 is when we're anticipating that some of the larger supply chain bottlenecks should start to ease. There'll be a number of measures that need to be implemented, and we've seen governments around the world starting to look at some of the logistical areas that they can help with. But we think that even with fiscal support starting to ease, and then on the monetary side, if we start to get rate hikes, that's also going to help to start to temper some of that inflation spike that we've seen. So I do agree with you, Jim, that we don't necessarily see gold as a good inflation hedge, but it is a supportive in a portfolio where we have high and unexpected inflation, which is not necessarily the scenario that we're in at the moment. So given our base case scenario that we expect inflation to start to ease, we think that for gold prices, this is going to be less of a positive driver, especially when we get to the second half of the year. And I'll pass over to you, Rhona, just in case.
I think that's right. And we do see this division between what institutional players think about gold and what the retail market thinks about gold. And one thing that I would just like to add quickly before I hand on to Rhona, there has been some talk recently, and there's been some work published by Stephen King, one of our economists at HSBC, about discussions in government circles, not the US necessarily, about the reinstitution of price controls. He wrote a paper on that, and of course, arguing very much against it. But I would just point out that if we do go into a period where prices are attempted to be managed, and sometimes you see this in the oil industry or in food, this is always positive for gold if that were to be the case. We don't think it will happen, but I just point that out. And it is this combination of monetary tightening, even from a low base, and fiscal reduction and increased supply that's going to put the kibosh, we inflation. And Rhona, any comments?
Yes, I can't possibly disagree with anything that either of you two had said, nor would I want to. But one of the things I think is interesting is if we go back philosophically one step and look at the nature of the beast. Gold is not necessarily an inflation hedge, but it is, as Jim, you were saying about being a diversifying element within a portfolio. That is partly because it's a hedge against risk. And I would argue that most economies need a little bit of inflation just as a lubricant to get things going, because it helps to encourage spending. But once inflation itself becomes a threat because it's out of control, that's the point at which gold kicks in, because we're talking about risk hedging rather than inflation hedging, and inflation becomes part of the whole risk profile. And I can't see, certainly with, as you were saying, with the way that monetary stimulus is being withdrawn, and fiscal stimulus likewise, I can't see prices going out of control unless wages really explode. But it looks as if the United States labour market is very much tighter than it is anywhere else. So I don't think from a wage standpoint, we're looking at global inflationary forces. And equally from what you've been saying from the monetary and fiscal standpoint, it's hard to see in any persistence, persisting, if you'll pardon my sort of semi-repeating myself, much beyond the third, fourth quarter of this year, frankly. So yes, I'm very much in the same camp as you two in terms of gold's role specifically on the inflation side of things this year, unless it becomes a real perceived risk, which by the looks of it, the central banks have got their act together, and that won't happen.
Suki, I think we hand over to you now for some additional words of wisdom.
Thank you, Jim. I think when we're looking at the global economy, we have to remember that we're in an era, as you've mentioned, Jim, where we've had extraordinary monetary accommodation, and that was very much driven to combat the COVID crisis. But we're now in a period where we are going to see that monetary policy at that level is no longer warranted. So we are expecting global growth to slow down this year. We're expecting global growth to reach 4.4% in comparison to 5.8%. And across all major regions, we're expecting a very similar trend, whether it's the US. We're expecting global growth to slow to 3.4%, and in Europe to slow to 4% from 4.9%, and even in China, we're expecting growth of 5.3% compared to 8.2% last year. So we think for many of these countries, some have referenced inflation being transitory. Of course, Fed Chair Powell has scaled back that language, but in Europe, they still see inflation being transitory, so we don't expect any rate hikes across Europe. But we're in an environment where the balance of risks, we think, to growth are skewed to the downside, But given that we're expecting supply chain bottlenecks to ease and inflation should no longer be perhaps as large a concern, we should perhaps look at what the other drivers for gold could be. And last year, very much, and I like the term that you've used, Jim, is that the dollar was held, the gold prices were held hostage to the dollar. And for last year, that was perhaps the largest drag for the gold market, and we saw ETF outflows accelerating. But this year, we've seen that gold's focus has shifted away from the dollar, and real yields is the strongest driver, with a correlation between gold and real yields switching between gold and the dollar. Last year, we saw the dollar and gold correlation reaching above 70% at some point. And this year, it's actually closer to just over 30%, whereas real yield correlation is stronger, much more consistently at the moment. But the dollar this year, we actually expect to weaken. So even if it was a drag on prices last year, we think that this year it's actually setting more of a supportive backdrop, which is why we don't expect gold prices to plummet this year. We think gold prices will come under pressure, but we're not expecting a sharp acceleration to the downside. And when we're looking at the drivers of the dollar, we see perhaps four main factors that we need to consider. Last year, we think that there was a lot of uncertainty and risk, and that led investors to choose to hold the dollar. And we think that desire is likely to ease this year. We also think that that dollar was favoured on the back of COVID concerns being heightened, whereas now we see that safe haven demand is perhaps likely to ease as COVID becomes perhaps less of a driver, and the latest variant is something that that economies and governments and can work with, and it will impact global mobility perhaps slightly less. So we see that being less of a driver to encourage safe haven demand, certainly in the dollar. But also we're perhaps past an era of extreme US exceptionalism, where we're not expecting equity markets to outperform equities across other countries. So perhaps that'll be a driver that leads to less interest in the dollar. But also when we think about the Fed increasing rates, it's not going to be the only economy that does so. We're going to see rate hikes in other parts of the world. So perhaps that and a hawkish Fed isn't going to be the only factor that would push gold prices lower because the dollar is strengthening. But if we look at past performances of dollar strength, if we do happen to see dollar strength this year, a hiking cycle does not necessarily guarantee that that dollar will be stronger. And if we start to see inflation easing, whether that's because energy prices start to come off, or we start to see chip supplies becoming better, we see better availability, we may not need to see a Fed being as hawkish as what the market is anticipating at the moment. So we do think that the dollar can weaken without necessarily seeing some bad news, but it's also likely to weaken more so against currencies where other governments are perhaps more committed to their inflation target. But overall, I think we're moving from a period where the dollar was perhaps the key driver and it was a drag on gold prices, to a period where the market is much more focused on different drivers, predominantly real yields and monetary policy easing. So monetary policy being less aggressive in terms of how accommodative it was, to the dollar being actually could be a supportive factor if it starts to weaken. So we think that the macro environment is shifting quite significantly, but all of the drivers that really influence gold are moving quite a lot in the current backdrop. I'll pass over to Rhona just in case you have anything else you want to add.
No, I don't think I have. Thank you, Suki. I think we covered pretty much all the ground, with the possible exception of geopolitics. That's sitting in the periphery, and that's going to be a tailwind, I would think, for much of the year.
Yeah, I think that's right. I think, you know, it was outside of the discussion of this webinar, but there's many other issues, you know, jewelry demand, income, things like that, geopolitics especially. But I think that's right. But I mean, we have a moderately, mildly bullish view on the dollar going forward for some of the things that you've touched on. A little bit of US, a little bit ahead in a tightening cycle, some superior growth compared to some others. It's not a structural call, but a cyclical one, so a carry on. But I think the important thing that you touched on, Suki, is that the gold may not be quite as sensitive to the dollar as it was last year, and that it's going to be real rates, which will still remain will still remain negative. Certainly on the other issues about safe haven, we do have to watch that very strong, monetary tightening. If it provokes a real stock market correction, we could see, and again, I'm not saying it will, but if further from here, we could see then gold's assets as a safe haven come into play.
I think there's so many different moving parts for gold this year, which makes it interesting in terms of the price outlook, the supply and demand balance. But I think one of the biggest changes has been that we went from 2020, where investor demand was the key driver, to 2021, where the physical markets made up for some of the shortfall that we were seeing on the investor side. Whereas I think in 2022, we're going to see both the investor side and the physical market playing a larger role in setting the outlook for gold. So I think the price action will be quite interesting to watch this year. I'll now hand back to Taylor just to see if there's any questions that have come in. Thank you, Taylor.
Not a problem. We do have a few questions that have come in. We do have one. Any thoughts on silver prices as a hedge of inflation? And what about uranium?
I don't think silver is more of a retail market. So we have seen a lot of demand come in on coins and bars. But again, it is more volatile than gold and is not a good hedge against inflation. It tends to be more volatile both on the upside and the downside of gold. And I thank the Lord that I'm not in charge of any of our uranium work. I just want to mention something very quick. I saw a question about HSBC being moderately bullish on gold. If I gave that impression, that is not the case. We're looking for the market to come under a little bit of pressure with the withdrawal of fiscal and monetary stimulus. So that was a question coming in, and I just want to clear that up before going on to any others, Taylor, if that's okay.
Yeah, of course.
The one thing I'd like to add, sort of piggybacking on Jim with respect to silver, is that yes, it's incredibly volatile. It's notorious for spiking. The end of January, start of February, so-called squeeze last year was a very good case in point. It didn't last very long at all. It was back to where it started within, I think it was 6 trading sessions. So if you're looking at silver as a hedge against inflation, you have to do it because you believe in gold because of the relationship between the two, although that is starting to break down to a degree. But if you have a silver position, the best thing to do with it is to hold it and go away and ignore it, because if you get caught up in its volatility, that way lies destruction, because it falls much faster than it rises, and it can rise pretty jolly sharply as well.
Great.
Sorry, Taylor. I was just saying I would agree with both Jim and Rhona's comments, but when we look at silver, and it does have a lot of the macro drivers that we see in gold, but it also has a huge industrial component, which means that it's being driven by slightly different dynamics to gold. But you can see that gold can sometimes follow in the steps of silver, in the steps of gold, and sometimes in the steps of copper. But I think the fact that it has that large industrial component means that it's perhaps not the best proxy as an inflation hedge.
Yeah, agreed.
Excellent. I think running on from that, we have a question from Joe De Rosa. If you believe gold is not a good hedging tool for inflation, what is?
This was something that I'd looked at in some past reports, and Jim's referred to some really great studies as well. But I think it depends on the period that you're looking to hedge, whether it's a short period or whether it's something for a longer period. If it's a long period, I think gold does act as a good inflation hedge because it's being just held in your portfolio, and for those periods of unexpected high inflation, it's naturally going to provide that hedge. But otherwise, the tips market can be much more effective at hedging an inflation risk depending on what duration that you're looking at. But I think it depends on what your main goal is in terms of your inflation risk. Is it something that you want to hedge for a short period or a longer period? So I think gold does have a role to play as an inflation hedge, but just not for, oh, I think inflation is going to go up for the next 3 months, so I'm going to buy gold today.
Yes, I agree with that. I'm not a strategist, nor do I'm allowed to give out alternative asset recommendations. but the generally accepted one would be TIPS. I'm not saying that that's mine or HSBC's view, but I'm just commenting on reaffirming what Suki just said. Yes.
Rhona, do you have anything to add, or I think we've got time for one final question.
No, can't add to that.
Right. I don't know if this is a question that you're able to answer, but I'll ask you, do you have a sense of the 2022 US and global wage increase percent? Again, I'm not sure if that's something you can comment on, but considering it was spoken about, I thought I would mention that one.
Well, it does appear that wage growth is going to be strong. I can look up and see if Janet Henry, our economist, has got specific numbers on that, certainly. But it wouldn't surprise me if it's going to be strong. But don't forget, productivity has also got to be taken into account. So the gross wage increase would not necessarily translate into inflation.
Okay, great. We do have a few more questions. Unfortunately, we don't have enough time to answer them all. But for those of you who have asked questions, I will forward them along to Jim, Rhona, and Suki. So if there's any information they can give to you, they'll be able to respond to you via email. If anybody does have any questions running on from this webinar, again, if you're listening to this back recorded, or if you have some questions stemming from this after we're done here, please do send them through to ask@lbma.org.uk, and we will again forward these across to Jim, Rhona, and Suki if we can't answer them ourselves. So that leads me to wrap up this webinar. So a quick thank you to Jim, Rhona, and Suki. Moving on to other webinars. We have one on the 10th of February and one on the 24th of February. So the one on the 10th is a members webinar. We'll be looking at the CEO strategy consultation with Ruth Kroll. So some details will follow if you've not already received them. And on the 24th, running on from what we've discussed today, we will have a look at the Precious Metals Survey for 2022. I do believe that will be going out next week. So we'll have panelists discussing that, and as you can see, lifting the lid on the survey. In addition to that, we have Lbma virtual training, an introduction to Local London on the 22nd, and how to use Local London on the 23rd. So if you have any questions about those courses, what they cover, or whether or not they'll be relevant to you, just email us again at the same email address. Be very, very popular inbox. And following that, on the 3rd of March, we have our Lbma annual members party. So invitations have gone out. If you are a member and you would like to attend, if you're able to attend, do get in contact with your primary contact. They'll be registering the members for their allocation. And with that, I do end the webinar. So again, a big thank you to Jim, a big thank you to Rhona and Suki. We've loved having you on board, and we do have a few more scheduled throughout the year to really follow this discussion and how it plays out across 2022. So we look forward to welcoming you back then.
Thank you very much, Taylor. Thank you, everybody, for listening.
Yes, thank you.